Thank you for an insightful and thought-provoking session. As we come to the final panel of the day, we are in for a treat with a discussion on alternative investments, private credit, real estate, and structured products. To lead us through the discussion, we have Ahsan Ali, Managing Director and Head of Islamic Corporate and Investment Banking at Standard Chartered. In his role, Ahsan oversees the delivery of Islamic banking services to banks' clients across multiple geographies and products, including financial markets, global credit, and transaction banking. Ahsan has played a key role in building the bank's Islamic business from inception and has led several award-winning and industry-defining deals. Ahsan, please join us on stage, and Ahsan will be joined by our distinguished panelist, Henrik Raber, Global Head of Global Banking at Standard Chartered, Mohieddine Kronfol, Chief Investment Officer, Global Sukuk, and Head of MENA Fixed Income and Franklin Templeton, Saifulrizal, CEO, Prudential BSN Takaful Malaysia, and Zaheeruddin Khalid, co-founder of Hilal Invest.
Thank you, Dr. Ala, for the introduction. Yeah, thank you. This is the last panel for the day, and we'll try not to prolong it too much. I understand many of you will have to, have flight to catch, etc. So we'll try and wrap up within the allocated time. So I'm joined by distinguished panelists today, as we said. So Henrik is from our bank. He heads our global banking business. Dino is a well-known name. He heads, the global Sukuk business for Franklin Templeton and also the CIO for the Middle East. He's from Malaysia, representing the Southeast Asian markets. He's the CEO for Takaful, which is the Takaful business of Prudential in Malaysia. And Zahir with me here. He is a veteran of the asset management industry in Saudi Arabia. He spent quite a lot of time. He was the chief investment officer for Jadwa Investments, which is one of the largest fund managers in MENA. And presently, he's the co-founder of Hilal Invest and also an advisor to the CEO of Sulaiman Al Raji Investments, which is a large private fund house for Middle East. So with that, let me just introduce the panel and the topic here. So, for pretty much past 20, 25 years, Islamic institutions, when they look at the investment side, primarily it has been into the fixed income markets, which is the Sukuk. It's been in Sharia-compliant equities, of course, and it has been in international real estate, right, in the US, Europe, etc. So that pretty much sums up the investment capital of the banks as well as the asset managers and Islamic capital arms, etc., within the region and in Malaysia as well. What we have seen now recently come up, the trend, are a couple of things. First, what we have seen is an explosion of private credit opportunities, primarily within the conventional space, within the developed markets, but we are also seeing the trend now catching up within the GCC. Secondly, in terms of real estate also, right? So within the local countries, there is more standardization coming up. There are more real estate opportunities, development of REIT, for example. We just saw that, one of the local listed IPOs is being planned for a REIT owned by a government entity in Dubai. In Saudi Arabia, the mortgage market has opened up. There are opportunities now for foreign investors also to invest in the Saudi real estate. So the real estate opportunity is also growing up, particularly within the GCCs. In Malaysia, of course, we have had REITs, etc., for some time. And then there are obviously smaller opportunities in the structured product space. So with that background, I want to open up to the panelists. Let me come to you, Henrik, first. From your experience, what do you believe? We can talk about the overall international markets, not just limited to Islamic market, but overall international markets. how do you see the opportunities developing up? Primarily, I would say in the private credit space and the real estate space. What are the sectors, the subsectors, structures, etc. you're seeing? And what is your opinion in terms of how can we transport some of the opportunities to this market? Thank you.
Thank you. I think the private credit space is probably one of the most exciting areas of finance and investment currently. There's also a huge need for the asset class, and the asset class comes in very nicely in addition to asset managers and banks, and increasingly many of these asset classes are merging into one. It's a little bit difficult now to define what private credit is. Private credit really started as direct lending by fund managers going around banks and directly lending to corporates. Predominantly started in the United States, then moved into Europe, and now is across the world. But as an asset class, it's developed. And really, anything that's a loan or an unlisted security or not traded on exchange could be classified as private credit. And what we're seeing is also with the demand for capital, particularly whether it be in real estate development or more so in infrastructure or in the AI space with data centers, etc., private capital is stepping in and filling that need. I think it's a combination of bank regulation, the demand for long-term, high-grade assets giving yields that are required to meet investors' demand that's driving this asset class moving forward. So far in the Islamic space, we haven't seen too many opportunities appear, but I think that's only a function of time. Underlyingly, in many of the private credit opportunities are real assets as well, which makes it a really interesting opportunity for it to be moving into more Islamic opportunities. So I think we're at the very early days of this. We believe it's a big opportunity, both in the GCC and elsewhere. We're very active in the space, and it fulfills the needs that both government and investors need around infrastructure in particular. And I think you'll hear a lot about the infrastructure demand, with investment needed anywhere between 20, 30, 40 trillion dollars to fill a range of different products. Private credit is probably going to be one of the solutions.
Thank you. Just to extend into the real estate market as well. So we have seen development of data centers, for example, right? Infrastructure projects and stuff like that. So, I mean, earlier, we were just talking about commercial real estate or RMBS, the residential. But how do you see this, the long-term infrastructure, etc.? How can we try and create, for example, the investors to participate in this growth story?
It's super interesting. If you look at data centers specifically, historically that was a project finance market. It was a traditional bank market by European and Japanese and other banks doing project finance work, developing a greenfield site and turning that into a data center. Now that asset class has moved into or merged into real estate investment, infrastructure investment. You have fantastic off-takers with very strong credit behind them, whether it be a Meta, Google, Amazon. So that whole space has shifted, and also the scale from being a bespoke investment into one of the major investment themes. Given the size of the asset class and given the ability to structure within the asset class, whether you're taking project risk, off-taker risk, or other opportunities, it is very good opportunity to look at, and also we need to work collectively about how we can develop Islamic products around that in scale, because it's going to also be needing regionally. We're seeing a lot of expansion regionally about building data centers locally. So that's a great opportunity in addition to international opportunities.
Thank you. So, obviously, as you said, a lot of work happening in the international space. And I think, like other things what we have done earlier, we need to do, some work to transport these opportunities or bring them to the Islamic investor base, clearly. Let me move to Dino now. So Dino, Franklin Templeton is a large global asset manager, and you have, Islamic capabilities, so you have the fixed income fund, etc. How are you seeing this market developing, especially private credit market within the Islamic, space, if I can say? And what are the opportunities you are seeing, and how do you are going about, bringing them here? Thank you.
Yeah, thank you for that. And again, thank you for having us here. It's a pleasure to be supporting these efforts by Standard Chartered, a relationship we obviously value very much. Look, I mean, it's no secret that many times when you're in emerging markets, you have the benefit of hindsight sometimes. You see a market in the US develop, grow, and then you can, make a reasonable projection and say, there is no real reason why we can't have something like this in this part of the world. We have all the ingredients, specifically within private credit, there's a huge incentive because you really mobilize the entire financial sector ecosystem. You use advisors, accountants, lawyers, bankers, and so on. So, you find today that policy is also very supportive for these types of things. And we have been involved in this, and we've done a number of transactions. But I do want to highlight maybe a couple of things just to, maybe give people a sense of the challenge that we face. It did start in the US post the financial crisis, but a very big impetus in the US was the fact that you had a very developed private equity market. And then for every dollar of private equity, for every dollar of private credit that you raised, you had $5 of private equity money. So they were a very important, impetus to kind of develop this market, and they continue to do that today. Before it was 5, for every dollar you had 5 of private equity, maybe that ratio is 1 to 3 today. But if you look at our markets, and in Asia, for example, these continue to be dominated by banks, and they don't have as large of a private equity market. So that puts the burden on the asset managers like us and our partners to have to go source deals and to do more of the heavy lifting for these types of projects. And I just raised this because I think this is one of the main reasons why you have such an enormous supply-demand imbalance, why the pricing is so attractive here. I mean, for a deal in the US today, you probably earn 500 basis points. In Europe, maybe 600. We can earn 800 to 1,000 basis points more. But the challenge of scale, I think, remains there. The fact that it's still relatively early days is another challenge. But in terms of the opportunity, we think it's enormous. There's no reason why this cannot be a $25 or even $40 billion market. And I think for all the stakeholders here, we should really think about how we can collaborate to build this out.
Thank you. So in terms of, if you wear the fund manager hat here, right? Now, the private credit by its nature is illiquid, right? Now, it is okay for an LPGP structure or for long-term investors or family offices, etc., to take a 3-year, 5-year view and say, okay, fine, money is locked in. But when you really want to democratize this and create a fund structure which could be sold down, maybe not to the retail, but at least to high net worth investors, etc., and they do demand, for example, liquidity, right? How do you create this balance between liquidity and your term investment horizon, etc.? Because obviously there is a balance and there is a trade-off between the two. What is your views on that now in the market? What is happening?
So you have, again, models. So if you were looking at a US private credit manager, they have these evergreen products which are suitable for the wealth channel. So what they end up doing is they say that maybe 15 or 20% of the money goes into very liquid securities or instruments, and 80% or so goes into these less liquid loans. And then you have a redemption and subscription cycle that's, say, quarterly, where they try to match as much as possible, taking all the legal precautions. But you provide some liquidity. The return is slightly lower, but you then are able to access, I think, a very different wealth channel and, as you say, make this available to a much wider audience. So now you have this model that's established in the US with private equity, with credit. Now, we can leverage that, but our bigger challenge, I think, is the fact that when you think about our funds today, or when you organize funds, they're going to be much larger deals, they're going to be much more concentrated. So our challenge is not going to be just the liquidity, but it's going to also be the concentration risk. A typical private credit fund in the US may have 100 positions. So you're talking about, maybe 2% or 1% or 3%. If you look at the funds that we're going to be looking at, we're going to have deals of 8, 9, 10%. So that means you need to focus a little bit on, you have to focus even more, I think, on your defaults. You have to think about your recovery values, and you have to have more equity upside. So that's why the expected return for these types of products necessarily have to be much larger, because when you start thinking about the fact that you may have losses and they could be significant, you need the other loans to really make up for it. So that's going to be the bigger challenge for us, is to really scale up the number of transactions as we move forward.
Maybe to add one point, because I think this liquidity discussion is super interesting and is at the core of some of the private credit discussions. But many times, and particularly the last 5 years, our public markets have become less liquid, including US Treasury markets, US corporate bonds. There's quite a few statistics that would say we're not nearly as liquid as we were before, whilst the private side has gotten more liquidity. So I think these liquidity pools are actually merging a little bit, and public is not always as liquid as maybe is made out to be. Now, obviously, if you're looking at redemptions or things like that in a portfolio point of view, there's a discussion. But if you're trading a private credit versus a public syndicated loan or a bond, those liquidity arguments have come together are not quite as stark as they used to be.
And you will see funds created to meet that liquidity. The same way you have secondaries, private equity, we're going to have secondary private credit where they buy these loans at a discount. But the fact is that they are less liquid. And I think as we project the world forward, and you start thinking about, I heard tokenization and others, you're going to have a much wider range of assets that become accessible through different channels. And so all of that is going to be competing for money. And these have, I think, enormous implications for valuations. And I think now we're talking about trade and liquidity, but I think what's coming down the pipe with respect to technology is, I think, a very significant reevaluation of valuations, from the dollar to equities, to real estate, to tokenized assets, and so on. So we are, I think, going to be in a very interesting domain.
Thank you. I think, quite an interesting discussion, because obviously these are some of the key topics when we talk to investors and others, right? So these are the questions raised. So good to hear that. Let me come to Zaheer. Now you have been involved, with the Saudi market for, close to 20 plus years. You have, in your previous role in Jadwa as head of, asset management, you have been also, launched some funds as well, either focusing on private equity or, structured products, etc. And also in terms of the opportunities within Saudi, which we are seeing. So, we have seen, for example, peer-to-peer lending opportunities. We have seen some invoice financing funds. As I said, the real estate market is opening up, so I see now a lot of real estate focused funds also in Saudi being launched. What do you see, so in the alternative investment space, which is what the theme is, moving away from private credit as such, how do you see the landscape developing in the GCC with particular reference to Saudi, in your opinion? Thank you.
Thank you. Assalamu alaikum, everyone. So I think, look, I'll answer this, but just taking cue from what Dino was saying. So, and what you said also with regards to invoice financing and peer-to-peer lending, that's an interesting space which has really mushroomed in Saudi. And typically we see in many products that they start off with for larger investors and they then trickle down to smaller investors. And in Saudi specifically for this area, it has actually started off from crowdfunding platforms. And now they've grown to a level where these managers are now offering institutional investors the ability to participate in these shorter duration lending opportunities, essentially. So it is, to me, very similar to a private credit risk profile, but very well diversified, similar to what, Dino, you were mentioning in developed markets where you have funds which are 100 plus positions. You can build those portfolios. Today in Saudi, lending to SMEs, generating double-digit returns with, for now, very low default rates. So, and done in a completely Sharia-compliant manner. So that's an area where there is, of course, a lot of development happening in Saudi. If you look at it from, and now today I look at it from the aspect of a institutional investor who is there to allocate. So for me, today I have opportunities in Sharia compliant private space within Sharia compliant native markets, and there are no issues in terms of Sharia compliance, but you have issues in terms of course, credit enforceability, et cetera, et cetera. But on the other side, you have the developed markets, which are non-compliant natively, and you want to have a diversified exposure to those markets in a Sharia compliant manner. And I think that's a space where I would expect like players like Standard Chartered could come in and play their role in providing opportunities and structuring them in a Sharia compliant manner, and dare I say, not using the wrapper structures, because there is a big population of investors, large pools of assets, endowments, family offices, at least 2-3 that I directly work with multi-billion dollars in size, that are there to allocate in developed markets in Sharia compliant manner, but in Sharia structures which are a bit more Sharia compliant, dare I say. So I think that's an area where I think there is work to be done.
Thank you very much, Zaid. So you picked up a question which I was supposed to come to later, but since you have already started, so let me complete that part of it. So we did hear Same earlier talk about, right, and I also don't want to shy away from the controversial topic, so let me just pick this up. Same did mention that the Central Bank of Bahrain, for example, approved a product which has a 33% Islamic and a 66% conventional exposure, and then it could be used by banks to generate, right, and it is through the SPV structure. We have seen, the UAE Central Bank come up and says this is not allowed in UAE and doesn't matter how many SPVs you put. So this is a hot topic, within the Islamic space. Now, the argument for having the wrapper structure was that, and again, as Sami picked up, that there are asset classes which Islamic investors do not have natural exposure to, and there is a limited local currency or GCC originated or domestic assets, right? So there's a dearth of that. So how do we diversify our liquidity needs or asset investment needs, etc.? And the purpose to allow the wrapper structure was that, okay, you have the exposure to these developed markets for which Islamic origination or underlying Islamic financing may be difficult to originate, right? So that was the argument coming from the scholars and the bankers, and that's why you see some markets have developed it, and Saudi, they have accepted, right? And we have seen some issuances coming or some funds being originated in that way. Some markets are not doing it. I'll come to Malaysia later, but so far we haven't seen anything there. So in terms of this now, yes, so as I'm saying, there is an argument to be made for the wrapper structure also. And as you rightly mentioned, there may be some conservative investors who may not like it. So how do you propose in your experience so far, if we were to go to a US originator or a fund manager and says we want to start doing Sharia compliant underlying origination, right? What arguments can we give them in terms of whether, is there enough pool of liquidity backing that? Are there very serious investors who otherwise wouldn't invest in a wrapper structure, etc.? So what are the pros and cons of both forms in your experience? Yeah.
Simple answer, you throw enough money to a problem, you will solve it. I have a live case, and I will not take name of the manager, but a very large global private equity manager and a very Sharia compliant family office reached out to them, and they reached out to multiple managers and said, we want to do a private equity strategy in the US, actually across developed markets, but mostly US. And we want the underlying investee companies to not have more than 10% debt. 10% debt. Okay? One manager agreed to explore that, and a really top manager. And they went back and looked at their private equity strategy, co-investment strategy, and they noticed that over the last 15, 20 years, they have done enough deals which were companies with 10% or below leverage, and the family office said, we will commit to you $250 million. Let's do this strategy. Either we will bring that money or we will syndicate and bring other like-minded investors for it. And today that fund managers has launched a $1 billion fund with that strategy. They are fundraising today. Some endowments that I am associated with have also committed to that fund. So there is, and when this idea came to me, and I've looked at investments for a couple of decades, I thought it is not possible, and I was pleasantly surprised that it was. So I think it all depends on how much money you put to it, you commit to managers, and it's a chicken and egg situation because you need to have someone who can come in and say, look, I will do this and I will get enough investors for it. And trust me, I can very credibly say this from Saudi perspective. I don't know as much about the other markets, but definitely in Saudi markets, there is literally billions of dollars available to invest in developed markets in Sharia compliant manner, right? This is 10%. People are willing to do it at 33%. If you have leverage of 33%. So the similar methodology that has been applied on public markets, apply on private markets, 33%, and the business should be compliant, and you invest in that. It's the other way around, by the way, 33% of conventional debt, not the 33% Islamic that you were referring to.
Yeah, no, I was referring to the Bahrain fatwa, which says 33%. Yeah, thank you. So, okay, so I mean, I get you. So you are saying that there is enough money who's also looking the other way. So while there are, obviously some funds which might, which work with Raber, there are a lot more money also riding on the fact that if you give them a truly end-to-end Sharia compliant product, they want that and they will take a bite.
If you just allow me one more comment, Ahsan. So I think the onus lies on the Islamic banking professionals, right? Or Islamic finance professionals, let me put it that way, including the asset managers also. Because we go for the easy way out. It's easy, let's do a structure and then we can solve this problem. And yes, there are investors who will say that if there is a fatwa, it's fine, we don't want to go in details. But trust me, there are institutions that have over time deteriorated their, and I would deliberately use the term, deteriorated their Sharia standards, and their reputations have been impacted in front of really Sharia conscious investors. So on the other side, if you make things a little bit more Sharia compliant, take that extra effort, you will still be able to address the requirements of the less Sharia compliant investors, right? So I think that it's the same argument that people say about Sukuk, right? That Sukuk conventional investors can invest in as well, and Sharia investors, but not the other way around. So same thing applies here. Okay,
thank you. Thank you. I mean, yes, interesting point of view, and it's good to know that yes, there's a large pool of money which is looking for real Sharia compliant solutions as well. Yeah. Let me now come to one on the Malaysian experience so far. So, from a Malaysian perspective, what is the sort of alternative investment space? I understand, as we had discussed, that private credit is still developing primarily, but you do have real estate and you do have REIT funds and stuff like that, right? So what's their experience in terms of the investment horizon, especially of the investment firms or Takaful firms, and you see any challenges or opportunities there? Thank you.
Sure. Thanks, Ahsan, and Assalamualaikum warahmatullahi wabarakatuh, and thanks for having me here in the panel. Maybe I'll just kind of caveat a little bit because I realize that I'm probably the only sole Takaful or insurance person here, and my perspective will be totally reverse compared to, what has been discussed here, especially when you talk about liquidity and all that. I think we have a reverse view of it. Maybe somewhere we can actually find complement and can elaborate further on that. But for just coming from a perspective of a Takaful company, I think our general philosophy is looking to invest long-term. Where we are is we want to meet our liabilities over the long term. We are not afraid in terms of short-term volatility, short-term liquidity needs, etc. So that's probably the general philosophy of it. And within Malaysia, and I believe within the Southeast Asia context for the Islamic Sharia compliant investments, is really just focusing a lot in terms of the Sukuk and equities itself. But there are bright spots coming up. REITs market is there in Malaysia. There are Sharia compliant REITs as well, but it's a very small proportion of market. If I just give a perspective, the total stock market capitalization in Malaysia is about 600 billion USD. REITs is about 10 billion USD, so it's a very small proportion, and Sharia compliant REITs is just half of that. So I think that's further upside that can be made with regards to maybe some of the Middle Eastern GCC kind of REITs, can also have dual listings or something like that within that space itself. Within the private equity space is gaining popularity. Official stats, I believe unofficial will be much more, but the official stats is in year 2024, private equity market is about 5.7 billion in Malaysia. There's no USD, there's no breakdown with whether it's Sharia or non-Sharia compliant as of yet. But while it's relatively small number, but the growth is about 40% compared to 2023 itself. So it's a space that's actually coming up. And even alternative fundraising, and this is more for retail, whether it's from invoice financing, whether it's a short-term working capital needs. Last year, the Securities Commission official stats about 1 billion USD, just on that alternative fundraising arena. So to me, there are bright spots in terms of alternative investments in Malaysia. I think the market demands it, but there are challenges. I think one of the main challenges, especially for Takaful operator, is with regards to regulatory capital constraints. Like, just elaborating further, for Takaful operator, we are more than happy to take a 5 years kind of funding or tenure for private equity, for private credit. But within the regulatory capital space, there are limitations in terms of restrictions. If you invest in private equity, private credit, some of it you can't recognize for your capital, some of it you only have maximum 10% exposure to a single counterparty. So things like that makes it a little bit more constrained. But I believe, there's something that as the market develops, I think we can work through with the regulator to find balance between allowing innovation as well as some balancing with safeguards.
I think you make a great point, because I think this issue of scale is a real challenge for Islamic finance. I know you were giving examples how you have family offices or endowments that can write big checks, but if we look at the market, for Islamic finance at $4 trillion, it's still, the overwhelming beneficiary are Islamic banks. And, then also in this conference, the banks were dominating a lot of the discussions. But the Takaful companies are less than 2%. If you look at mutual funds, they're, roughly $120 billion. So the issue of scale is one that we have to contend with. And, we need regulatory support, we need stakeholder support, we need different initiatives to mobilize larger pools of capital, because on our own, the incentives, at least short term, aren't evident. It takes a long time to build a Sharia-compliant business and to scale it. And not everyone has the patience. And when you have the different challenges we were talking about, from standardization to regulatory issues and so on, those are real obstacles that we have to address.
No, I fully agree. And especially when you're talking to, say, again, Zaid's experience is a bit different, but For example, in your own institution, how much is Islamic assets as a percentage of your global investment pool today? Yeah, in Franklin.
It wouldn't even make a side note. If you I mean, we've been trying to build and we've been very committed, and it falls under 3 complementary. So when we got into the Sharia compliant business, it was part of an overall, kind of thought process around making sure people can invest in a manner that's consistent with their value system. So part of ESG, part of responsible investing, part of that, so that was an important strategic initiative. Then there was the entire concept of customization, right? So we want to make sure that whatever it is that we have, we can customize for our big clients. And that was where Islamic finance also kind of got a little bit of a benefit. But, you take that journey in 2008, 9, and you fast forward to today, we're at $5 billion, give or take a little bit. But the company has gone, at the time it was maybe 300 billion. Today it's 1.6 trillion, 1.7 trillion. So I think the commitment is there. We're thinking long term, but not many companies have the patience, and the commitment that we're displaying, obviously.
Yeah, I think, so it is a balance because, again, we also work in an international bank, right? And you heard, from today morning, right? So Standard Chartered is fully committed to it, but overall within our own, global asset book, if you see, we are, probably 5% or less, right, Islamic. But despite that, we have this huge commitment, right? And, it's pretty evident here today. So obviously, all of us have to spend time and money and make sure that we keep digging at it because, we are here for the long-term game. So just changing a bit of flavor now, from a regulatory perspective, governance perspective, again, maybe, I'll direct it to the, first and to Henrik later. What is the key differences you see in the risk? What advice would you give to institutions as to how to set up their risk management framework when allocating or building up an alternative investment portfolio as compared to your traditional investments? Do you see any differences in that governance framework they should focus on?
That's a great question. I need to think about that. I think like when you start dealing with alternative investments, the issue around transparency, around liquidity, around governance, I think certainly requires a different set of approach. And I think most institutions, from what I've seen, the sophisticated ones, a lot of them reach out for additional support. So they've all got their, fund selector and investment teams, but almost all of them rely on external providers for operational due diligence, for, even manager due diligence, and so on. So I think that when I think about their investment process, almost all of them have additional support that goes into play because they, generally speaking, are understaffed to be able to cover the entire range of risks that are involved with something that is less liquid, more complicated, etc. So that would, and then not everyone can access that. So I think that's one of the key challenges, I think, when we think about taking what is essentially an institutional product and then wanting to make it available through these different channels. The provider has to be, mitigating that risk to some extent, the regulations. There's different bodies are playing different roles to make sure that the end investor and all these different risks are being looked after, because without it, we're 3, 4, 5 years away from a pretty significant problem.
Okay, thank you. Maybe I'll ask a different question to Henrik. Obviously, private markets have grown exponentially, right, past a few years, and there is a huge money, being thrown at this now, right? Now, with the U.S. economy, and we heard, Eric Robertson was here in the morning, and he talked about the risk of stagflation in the U.S., right? So, do you see any risks to the private credit markets? Because this has been untested so far, right? It's only seen a growth. Is this the first real challenge we might see in the private credit markets? And I also saw an article on Bloomberg where one of the the CEOs of one of the firms said that some of the private credit deals are trading as low as 50 cents to a dollar. Maybe it may be a single deal or something, but do you see this, perhaps this challenge coming up if the US economy, stagnates or there is a downturn, and especially because the private credit space is primarily the SME and the ME sector, right? And because also some of the private credit, the covenants may be a bit loosened, they may not be as closely monitored as banking loans, etc. So what's your view on that?
So I think it's linked to the risk question, which is a great question. And, private credit, it really comes down to you're relying on doing the same, if not more diligence. You're relying on similar, if not stronger documentation that you've been able to achieve and stronger covenant package. Most of private credit is loans. That's what we're really discussing. And a lot of the private credit is investment grade, so we shouldn't just dismiss it as the high yield bucket. But clearly, if we go into an economic downturn cycle, the weaker credits will get more impacted. And then if we go back to your earlier question about what risk analysis was done on the private credit deals, this is really fundamental. What covenant packages? Were the covenant packages looser because it was done as a private credit transaction versus a syndicated bank transaction? Now, the managers will, for the most part, say no. They have more stringent application around the diligence they do. Many of the large credit managers have very significant credit analyst teams, do their own credit grades, etc. But in any downturn, there will be credit accidents and there'll be strains, just like we've seen in the leveraged finance market. This is a segment of the market that's always existed. There's always been SME lending. It's shifted. With regulation post-GFC, a part of that has moved from banks into predominantly asset managers or direct lenders. Now they're going to be exposed to that risk. You're right in that has not been really tested, those assets sitting with a different holder at this scale. Now, I don't think we're going to have a big sort of downturn. We may have a softening of economy. But you'll also see the fallout in just general leverage finance transactions, that they'll be weakening. So it's going to be the first time we test it. The whole regulatory space keeps coming up around private credit, the regulations around it, not regulated, the linkage to insurance companies. It's a big topic of discussion. So far, the statistics show, and the big managers will show, that their credit performance is as good as they are compared to other managers. But time will tell on this.
I would add that it was tested during COVID. I think that was a pretty stressful environment, and I would say by and large the private credit space did well, certainly in the more developed markets. I think something else also is that you do have a very large private equity market that's twice the size, that technically stands first to lose. So you do have all of that equity that needs to get wiped out before you really start hitting the private credit markets. Also, there is one of the things that people monitor is the amount of dry powder, they call it. So money that's available for private equity investors as well as for private credit investors for new deals. And that's at a very healthy level right now. I want to say it's in the sort of $300-400 billion. The short answer is we will see. I think it's all a function of how big the downturn is and the amount of leverage in those companies. But the fact that you have a very large private equity market, that you've got some dry powder, those are some mitigating factors. But yeah, I mean, the fact that you have such a large part of, you have $8 to $10 trillion right now in that private domain, which, is less transparent. And if we have a downturn, we will see. And if they, my worry is that if they do get impacted, that's kind of where you'll start finding people laying off people, and you'll start seeing the unemployment rate go on, and that'll have a real impact on where the Fed goes and how the markets end up behaving.
The only thing I'd add is in private credit space, the managers also have skin in the game. They are investors in their own fund, and obviously they have responsibilities to very significant LPs. Global sovereign wealth funds, etc. So I don't think it's been just the Wild West that any sort of loan document's been written here. So we should put it in the context of there are guardrails because you have responsibility to your investor. But it's going to be an interesting experience.
Yeah, I think let's wait and see. We don't know. One of the things which again Eric was saying is that maybe there will be a large fiscal stimulus, unleashed by Trump, and that may actually help the economy tide through. So things like these. Again, I mean, it's the U.S. market, which is the leading market. I mean, the
that's
GCC,
our biggest
for example.
worry. If it does that, that would be our biggest concern.
Yeah. In the GCC, let me just quickly ask Zaheer a couple of minutes from you. Now, you did mention, and we talked about things like, the securitizations being done, for example, on personal finance lending, right? There's a lot of now P2P intermediaries which are coming up. So it's not, earlier it was only banks, but now you have finance companies, you have P2P intermediaries, you have these trade finance companies, all of these, right? And then we are seeing securitizations being done on the back of that. The real estate funds are coming up. How do you see the growth in the GCC market as a whole? And, compared to today, for example, if you say that maybe 10% is or less is into this alternative investment space versus 90% in the traditional financing, how do you see this shift in the next 3 to 5 years?
Yes, I think it's a growing space, a broader GCC as well, and specifically in Saudi. Actually, the largest asset class in terms of funds in Saudi today is real estate funds. So, and more development rather than income generating, but still that real estate has the highest number of assets under management in Saudi. So it's and it has grown significantly over the last 10 years. So I think that is something which is growing. It's coming from two aspects. One is, of course, the demand, and as more and more investors start to understand that in alternative investments you can have a higher return, of course higher risk as well, but if you can bear that risk, then you can generate risk-adjusted better returns. But also enabling environment where lending is available to those asset classes which was earlier not available. It was difficult, for example, in Saudi to get lending for funds to borrow to develop properties. So now that is happening quite frequently. So I think that those are the enabling factors which are growing. I think some nascent asset classes which will probably grow in future as well here, and which have done well internationally, are the smaller ones like the aviation leasing or equipment leasing. There is trade finance, although given what's happening on global trade, I don't know what will happen, but I think that's an area where naturally these are more amenable to Sharia structuring, and they provide returns which are differentiated from general capital market returns, whether it is fixed income or equity. So I think these are the areas where at least we see some growth happening.
Thank you. And that brings me to the final closing round, maybe 30 to 60 seconds with each of our panels. So I'll start with Henrik. So if you had to allocate new capital today between private credit, real estate, structured products, where would you allocate in terms of over allocation, underweight, overweight, and why?
I would be actually relatively evenly spread across the asset classes. The one I think that's going to be most exciting is the infrastructure space. I think there's huge opportunity there, whether it be transport, digital, etc. And I think the topic we just touched upon, I think securitization outside the United States is going to be an area that explodes in opportunity. There's already been a lot of talk about Europe needs to develop its rules, is quite far behind. I think in the Islamic format, there can be really good opportunities around using assets or secured funding to provide capital relief or leverage, or giving a part of the capital structure that fits the investor, whether you want to be in the AAA or in the junior part of the capital structure. Securitization is a very effective method of aligning capital and return. So those are the two areas I would be focused on.
Thank you.
Yeah, I would think on the balance, I think, anything that is focused on income, fixed income, is an area where I feel the asymmetry today is very favorable. I think you invest in anything that's income producing today, you're either going to make a little bit of money or you're going to make a lot of money. But I don't see you losing money. I think on other risk assets, I'm fairly cautious, and I would have, the lower end of what, I can. I mean, you're never zero anything, but, I would have the least amount of allocation to sort of equity and risk assets, and I would have now more to income and fixed income and private credit and these types of asset classes. And once we have an adjustment in valuations, I can make those shifts. And I would definitely make sure that I've got a healthy proportion of liquidity.
Thank you.
Well, I guess from a Takaful perspective, assuming that regulatory capital wasn't a constraint, to me, the alternative asset class actually is quite attractive, especially as a diversifier. Diversifier from a risk perspective as well as from optimizing the return profile. Why do I say risk? So for example, I mean, in the past few weeks or months, you can see the volatility in all the Sukuk equities prices, and with private equity, private credit structure, it helps to cushion it a little bit more. But from a return perspective as well, for us, like I mentioned, we take longer term view, and we are happy to actually take a higher duration kind of a premium in our investment.
Thank you.
So I think asset allocation is a function of the investor profile, right? So I think if you have the appetite to have a higher risk return trade-off, then I would have today, I think, maybe a little bit of cash liquidity, as Dino was mentioning, maybe 15-20% available for you to build your exposure in the liquid risk asset classes like equities as they go down. But income generating alternatives are important. I think data centers you mentioned, infrastructure was talked about. I think these are interesting asset classes to look at.
Thank you. Let me now open it for any questions. We're happy to take a couple at least. Here. Come on.
Assalamu alaikum. And first of all, let me thank Standard Chartered Bank for organizing such event. So I think it's the second year for me. And as usual, great audience, great speakers. And I would like to personally thank also Brother Kuram, who's been instrumental, I think, with your team coming up with this kind of event. Let me try to frame this question properly. So there is, the old gold 60-40 asset allocation, I think, is dead. And I kind of struggled with the title, alternative investments. If you club all of them together, private credit, real estate, structured product, I think we are more of 40-30-30 or 50-20-30, because now you have a positive correlation happening in the market between equity and the bonds. We know the interest rate risk is there. Then if you go to private credit, less volatility, you get the floating rate, return. So you can shy away from the, volatility that you may be exposed to on the equity and on the fixed income market, especially now. And we've seen it, I think, for the past months or so. So this is a question directed to Henrik. Did you see among the different asset allocators, this shift from 60-40 to 40-30, 50-20-30? Then I have a second question directed to Brother Zaid, and have a very, very interesting conversation with one of the biggest private credit firm in the US. And they come to us and say, okay, listen, we may need your help to put up, because we are very interested, we got a lot of requests from Saudi, to come up with a private credit fund. We started working on the structure, the wrapper, trying to put up 2 SPVs. But then you have to look through, the murabaha. You can put 1 SPV, 2 SPV, 3 SPVs, add up the murabaha, the undertaking, benchmark the return, but the core underlying asset remains the private loans given to the US corporates. But now there is a question. If we put some safeguards, such as you put the screening ratios, debt levels, you obviously don't bank corporates that are involved in alcohol and all those forbidden industries, and you keep those loans as is, because in the US, it's difficult. You cannot go to a US corporate and say, I would want to enter into Modaraba or Morabaha financing with you. It's not going to work. And then obviously those guys, they're not interested to build a private credit here in the region. The market is not deep enough. Okay, the mid-cap corporates are they are overbanked. We've done this in Saudi, and all the banks are fighting for those mid-cap corporate. And you don't want to go to the SME market because it's an immature market in Saudi or even in the UAE. So I think it's kind of a chicken and egg situation. So we need to be conservative, but we also need to be flexible. And we need to understand the reality of the market. So if they want to have diversified risk, I'm not saying that, they need to understand that the US corporates, they will never enter into commodity murabaha. They don't know.
For the benefit of our panelists, if you could just give your name and the institution, please.
Oh, yeah, sure. Mohammed Abdelrazak from Bank ABC.
I want to challenge just this idea that mid-market companies are overbanked. Because the reality is the data doesn't support that. If you look at the banks in the region, they're all, obviously great and competitive, but they do a really good job catering to retail and to larger corporates. I think the segment in the middle in general, we would argue is underbanked. They can't access capital competitively. If you go to most people that are starting businesses, they struggle to find financing with banks, and that's the main reason we think there's a big opportunity in the private credit space. If you think about employment across the GCC, more than 50% comes from these mid-market companies, but they get less than 5% of the loans. So I'm not telling you that it's not a challenge to try to, cater to that. It's an issue to scale that up, but I don't think it's a fair characterization to say that they have access to the funding and the banks are doing it, because the data just doesn't support that.
In Saudi Arabia, I can tell you that at least when I talk, it depends on the definition of mid-cap corporates, okay? So if we talk about mid-cap corporates with an annual turnover of above 200 million Saudi riyal, then they would be of 500, I don't know, it's relatively small for banks, for internet banks such as Standard Chartered Bank, but for the regional banks or the local banks, they are well covered. But then if you go, one notch lower, then yes, definitely. Okay, the one that generates $50 to $100 million of turnover, they're not well covered by the street. So I'm talking about, this segment, above 100, 200, or 300, all the way to $1 billion. Because once you move up, then obviously you face the big guys. And it's fairly complicated as well.
Yeah, sorry, Henrik, you have
I think the one, just to quickly answer your question, where we've seen, I think it depends on where your starting point is as an investor. But the one area we've seen quite a big shift in terms of investors is those who've had heavy exposure to private equity. And the reason for that is that after 5 years, they've seen very little cash back. So there have been secondary other opportunities. But in order to get income into their funds or into their ecosystem, they have gone into private credit or into more fixed income type assets, because they also need the income and the cash flow for other reasons. And they're still waiting for the private equity funds to do the returns. Now, this year was expected to be, a big year for IPOs and other activities and the private equity funds to start returning a lot of capital. Now, that's not happened in the first few months. We'll see if it happens in the second half. But that group, and that includes some of the large sovereign wealth funds, etc., they have aggressively pitched more of their assets towards income-producing opportunities.
You see,
you want to say something?
yeah, that's also one of the motivations for a lot of these continuation funds that you're seeing right now. It's precisely to be able to address the need for that liquidity. They need to monetize, they don't want to sell the assets, so they're kind of moving them into these new vehicles and trying to get that available.
Thank you. Zaheer, you want to pick up that question?
Yeah, just on the private credit question. So, look, I think the way at least I look at these things is the following. There are Sharia native markets like the GCC, like Malaysia, Indonesia, in the Far East. In these markets, you can do the whole spectrum of asset classes, right? Because there you can do private credit, you can have your loans structured in a Sharia compliant manner, and you can do everything, right? And I think that should be the focus of the institutions operating in this region, that for this we can do and try to be as Sharia compliant as possible, right? In the developed markets, which are non-Sharia compliant natively, in those markets, I think start off with doing products which are easy to handle. Real assets, leasing, trade finance, equipment leasing, these type of things are easy. Real estate and real estate, private equity to some extent, as I gave the example earlier, is possible. Private debt, CLOs, and there are Sharia compliant CLO offerings today in this region by managers investing in conventional CLOs using Raber structures. I think those are I think those are products we should, my opinion, again, stay away from, unless you reach a critical size where you can then start dictating underlying users to structure contracts in that manner. But again, there is a whole spectrum of investors with varying Sharia asset preferences.
There is just one interesting thought came to my mind. So, for example, the brother here really mentioned that it's difficult to go and convince a corporate out of US, and especially when he's getting, enough money, for example, in a conventional format. Do you think that the investors here, the real Sharia compliant investors, are they willing to take a 50 basis point cut in return in exchange for asking the borrower to go and sign, for example, a commodity murhaba type of a structure, which is a straightforward structure, and as long as it doesn't interfere with its operations, etc. Do you think the borrower would be amenable to doing that if you're telling him that, okay, you will get some discount in rate, and are the investors willing to pay up for that?
Easily, because the Raber structure costs you 50 basis points anyways, right? So, but conceptually, it's not about 50 basis points, but I think there is, when Khurram and I started in the Islamic banking, Islamic finance space, we heard this term COBM, cost of being Muslim. So yes, there are investors still out there who are willing to pay this cost if the things are structured in Sharia compliant manner.
Okay, thank you. Interesting to hear. Are there any further questions? If there is any, we can take one more. If there's none, okay. Thank you. Then thank you to the esteemed panelists. I hope the session was interesting. I tried to make it as much as possible. So thanks, everybody.